Good morning, everyone. Now, let me just share the screen with you then. Okay, yesterday we were doing one example. It was just comprehensive example, and last part was like we calculated depreciation. Okay. And the depreciation was calculated, if you remember. Let me just go over again from the beginning, just quickly, so that you can just remember what we were doing. So this was the project that we were working actually. We had a fixed capital investment, which was 2 million, and the project has expected 6 years of life. So it's 6 years, 2 million. And net working capital investment initially was 200, and then it was like 1/6 of the next projected cash flow. And this is how we calculated. We said that for the first year it should be 1 to 6, it's 0.16 times the next year sales, minus the initial investment in net working capital. And then you proceed to the second year. But in the second year, we subtract not only this 200, we subtract as well this 50, but we are multiplying with the next year sales. And we proceed with the 3 years, subtracting 250, 62, and multiplying with next year sales. And with the 4 and 5, it's like goes respectively in the same way. And then we come up with the sales. It's given fixed cost. It's available here. So we were just putting all the numbers and depreciation. Now is the time to calculate. And guys, these numbers are all of them are negative, okay? They should be all of them negative because this is kind of outlay, okay? This is outlay. This is all like first 2 rows are outlay. The first 2 rows are the costs before deriving any operating, the cash flow from operations like after the tax. So income before tax, we said, is just using the income statement approach. It's sales minus all the costs that we have it here. And we get like minus 30 here. And we do the all for all years. So all of them are same for all years. And next, we need to apply the tax rate itself. And tax, we said, is equal to 30%. No, it's not 30, sorry. So yeah, the marginal tax rate is equal to 30%. So 30% is tax rate. Then I mean the 30% of this is minus 9, which is kind of subsidy, like it's a negative sign, but in here it's all positive. So what we do in here, we need to subtract everything to get operating income after tax, or EBT after tax, like earnings after tax. So operational income after tax. So operational income after tax is equal to, we're just subtracting all the numbers. Minus 21. Now we proceed with this. And then what we need to do, we need to add the depreciation back. We are adding back, okay? Adding back the depreciation amount, which was this one, 600. After tax operating cash flow, then will be equal. So the operating cash flows after tax that we were looking for is equal then make it like this. So we're adding a depreciation back. That's where we get it. And now we need to calculate terminal non-operating cash flow, and it is how we calculate it. As you remember from the previous example, is the salvage value. If there's something that we sell it for, our like project, if we sell at the end of the year, we have to pay for it. Some taxes, which is as well should be paid. And apart from that, we need to add all return on net working capital. We should add all the return on net working capital. So the terminal non-operating cash flow is equal to, and we said that we should include, first of all, the salvage value. Okay, the salvage value. Let's see what is the salvage value. Like Lawton will sell its fixed capital investment for 150,000. So this is the salvage value, and 30% of it we should subtract it because there is a profit we make it. So we need to subtract it. So it's 30% of it, which is 45. That means that salvage value 150 minus, I'm ignoring thousands, okay? Thousands I didn't take into consideration from the beginning, minus 45. This will give me, this is 45 is representing the tax rate, like 30% of 150. Then I have to add here 200, that net working capital, net working capital investment. Initially it was 200, and every year there is additional on it. We have to take into a consideration. So we're going to add them all, which is 260 as a cumulative. If you sum it up, you're going to come up with a 260 approximately. And in total, so we need to see what will be the equal amount. Okay, so these things we should calculate and come up with a proper number. So which is 150 minus 45 plus 200 plus 260. So 521, okay? This is what we get it as total non-operating cash flow. And final operating cash flow after tax, final operating cash flow after tax is in the following way. So we have investment cost in the year 0, which is total cost here, okay? We need to put it minus 2,200. It's 2,200,000. So this is our investment cost. And our operating cash flows, guys, one thing I want you to see that this is the numbers, okay, that are net working capital required is the investment cost, okay? Apart from our sales, we were making investment in net working capital. That means that we were spending the money, okay? That 50. So that means when you derive the final operating cash flow after tax, that should take into consideration that net working capital investment. So 579 minus this, okay? And it's all the same until here. But for the last year, it's different, because for the last year, we're gonna subtract and make some additions, okay? So this minus, if we have something in that year, we don't have anything, but let's do it. And plus this one. Okay. We are adding back always the terminal non-operating cash flow to the last year, okay? And this is our cash flows that are generated to actually to calculate the NPV. This is what we're actually looking for. This is our projected cash flows, okay? And let me just tell you something. At the end of this, not today, but at the end of this chapter, we are planning to run different scenarios, different sensitivity analysis, scenario analysis, simulation. So we will simulate, we'll try to create different scenarios, like best scenario, worst scenario, and the normal scenario. This is actually the normal scenario, but we should create the best case and the worst case as well. And there are ways how to do it. I'm gonna show you as well by considering. There's something else which is called Monte Carlo simulation analysis that we're gonna do it as well. So NPV and IRR. So NPV for this project but we forgot to include the rate, and the rate is our cost of capital is equal, the projected required rate of return is 12%, okay, 0.12. Our investment cost we are subtracting. So our NPV is equal to 1,000, like 1 million, we can say 1 million. Our NPV is equal to 1 million, okay? And IRR, let's calculate it. It's not 20, but it's rounded. But if you make the things up, okay, 26.59%. Okay, our IRS 20. So according to this, we will accept the project, actually, the expansion project. This is called a kind of expansion project. So this is an expansion project. We're gonna accept this project. Okay. And as I told you, like it's a just normal case. So we'll have worst case, we'll have and best case as well. We'll compare these all three cases, and then we're gonna come up with certain conclusion whether we should accept or not. Okay then. Now let's move further. Do you have any questions, guys?
I have.
Yes, please.
In terminal non-operating cash flows, shouldn't we tax the gain from selling?
Yeah, we tax already. We tax it's here 45 minutes. Like I didn't put it here. Like this is the way of calculation. Like 150 times 0.30%, it would give you like 45. Okay, this is the tax.
Ah, okay.
We're taxing now. Thank you so much for asking this question. That's good. Okay.
Thank you.
I also have a question.
Yes, please.
Why the answer from OCF after tax is different from final OCF?
Yes, one more time. Operating cash flow after tax is what we got. It. There is no problem, okay? However, we said that every year there will be investment in net working capital. That means that we will spend our money in current assets and current liabilities, okay? Net working capital is the difference between the current asset and the current liability.
So it means we need to
subtract, yes. From this number, we're subtracting it. Like 579 minus 50,
okay.
And we get it. Okay.
Okay. Thank you.
Okay. Do you have any questions? Okay. Then let me go further. So guys, I'm gonna upload this today. I didn't upload anything yesterday because it wasn't reasonable to upload because we have not finished anything. Now I finished this file. I'm gonna upload it. Okay. Okay. Now. This is what we did it. Great. So let's move. So actually, the capital budgeting analysis, when you do the capital budget analysis, there is a thing that really affects, and that thing is inflation. So there's some terminologies that are called nominal and real cash flows. The nominal cash flows, they basically reflect the impact of the inflation. So they include the inflation effect. But when it comes to the real cash flow, the cash flow, they're actually adjusted the inflation to inflation. That means that we are removing the inflation from the real number. Okay, this is what it means. Like when you see the terminology like real and the nominal cash flows, and if it's nominal cash flows, they're including the effect of inflation. But when they're real ones, because if there is inflation, in our example, if there is inflation, that sales will be upgraded actually. It will go increase and it's going to be increased, the sales, if there is inflation. But if it's real, that means it will be adjusted to inflation. So we'll take out the inflation effect. So the changes in inflation that affects actually the profitability. So inflation is higher than expected. The future project cash flow are worth less, and the value of that project will be lower than expected. So actually, when you calculate, when the interest rate is given, the interest rate takes into consideration the inflation itself, because as more interest rate, more inflation will be. Sorry, that will show that there is a huge inflation as well. Due to that huge inflation, the interest rates need to be adjusted to that thing. So inflation reduced the tax saving from the depreciation, and this is the as well a reason. So the tax saving from the depreciation is the cash flow, which is generated from deductibility of the depreciation. And how the actually inflation affects the capital budgeting analysis. So inflation basically decreased the value of the payments to bondholders, because when you lend the money and whatever you receive in the future, it will be having less purchasing power. That is what it means, like reducing the value of the payment. And inflation may affect the revenues and the cost differently. If the price of goods change in a different rate, and then the price of inputs are used to create that goods, so the firm's after-tax cash flow could be worse and could be better actually. So it depends on how it will change. So the project analysis and evaluation. So what if the projects are mutually exclusive and have got different useful lives? And what happens under capital rationing? Like what if there's a capital budget constraint given? And how do we deal with it? How are we going to come with a certain conclusion to accept or not? So when we compare a project that have got different useful lives, and we cannot simply compare the NPVs, because of the time replacing the project would be different, and the number of the replacement between this project would be different in order to accomplish. So if there are two projects are given, you cannot select with a different useful life. I mean, with the life of the project itself, you cannot come up with a conclusion, okay, I'm going to choose the highest NPV. So it's not the case, actually. We need to take into consideration there are other stuff, like we need to apply extra approaches to come up with a certain conclusion. So we are given two projects in here. Those approaches are least LCM, which is called least common multiple of leaves approach, and equivalent annual annuity approach. So we're going to see them how to calculate and to come up with a certain decision. If the two projects are mutually exclusive, that means that you have to choose one project, and you will not choose according to the NPV with the highest one in this case, because it's still the information is not available. So because this is requires it is less 1 year investment. So if it was like 4 years, okay guys, both of them, if it was 4 years and here we have 0, then definitely you're going to choose the NPV with the highest one. But however, in here that means that project H has got 3 years, but project G has got 4 years. So you cannot compare them. You need to kind of make them standardized. And one way is to do it is using LCM, is least common multiple approach. And the other one is equivalent annual annuity. So let's start with the first one. Now we are given two projects here. Okay. Project S and project L. In here, we see that project L is giving you higher profitability, and project H is giving you, sorry, project S is giving you less profitability. So basically, you have to select which is highest NPV, but we cannot because the number of the years are not the same. But what we do under the multiple leaves approach, under the least multiple approach, what we do, we need to create replacements. Like, what if this project will repeat, but will repeat in an equal amount? So we consider like 6 years. That means the project S will repeat in 3 times, but the project L will repeat just 2 times, and then we will be able to generate the equal MPV, the equal evaluated MPV. So we actually put here minus 100. This is our investment cost, minus 140. Then we proceed the equal amount, 60, 90 for this. So this repeated once, okay? Then we proceed again. $60, 90, 60, and 90. Okay? So we repeated 3 times. This is the first repetition, okay? We repeated once. Then second time. Then the third time. But as you can see, when we replace second and third time, we don't have the investment cost. Then we should have it actually in here, but we're going to add it back. We will add our investment cost, okay? We're going to add it, but that investment cost would be added to here because you can see it from the year 0. If it's, we assume this is year 1 and this is year 2, year 1, year 2. So if it's year 1 and 2, our investment cost should be in year 0, so which is 90. Our investment cost is minus 100. So we get just minus 100 plus 90 will give you minus 10. So this is 1, and we continue here. This is year 1 and 2, and here.
Sorry, Professor. Could you repeat how you derive minus 10?
Yeah, sure. Now, did you understand what I did here until this point?
Yes.
Okay, we repeated our investment as it is, like restarted again. Now, by restarting, we should take into consideration our investment cost, like first, second. So this is like, as you can see, from 0 to 1. But here, from 1 to 2, but we have here some 0 years. Okay, we are assuming this is year 0. And we need to put minus 100 plus 90. Okay, this minus 100 is the investment cost for the restarted project. Minus 10. And then we proceed same in this way. So this 1 and 2, we go with the investment cost here as well. Minus 100 plus 90. But for project L, it's 80 and 70. And what happens in here, and we have 60 here, yeah, true. Then 80, 70, 60. And now we need to add the investment cost. The investment cost, look, 3 years here, and the investment cost should be in year 0. We are assuming this is year 0. So this is year 0, minus 140 plus 60. Did you get it?
Yes.
So this is how we derive the NPV for like we're standardizing to compare the NPVs. Now we can see which project is more profitable. Now we can see that the project S is giving you higher the NPV. Now we can select project S.
What's the rate of return in this case?
Ah, sorry, I didn't tell you the rate of return in here. The rate of return in here, it's 10%.
Okay, thank you.
It's 10%, okay? This is how we do least common multiple approach, okay? This is how we apply the least common multiple approach to select the, so according to this, we cannot select, so we need to run again. So what they do here, like they're assuming that we are running the NPV. So this is another example, guys. We can run if you want. I can show you this. Do you want me to show this example to you in Excel?
Yes, please.
Yes, it would be better.
Okay, to understand better. Okay, then I will put it here below. So let me just copy this. So project not S, but it's project G. project G and H. And the number of years are not good. Okay. Now, G and H, G has got minus 100 and 30, 30, 30, 30. 4 years, okay? And that one has got 38, 39, 40. So this is 38, 39, 40. And investment cost is minus 100, same. Okay, did I miss anything? What is the rate? Rate is 5%. And I'm going to consider, say, let me just put 0.05. Required return is 5%. Now, what I need to here, I need to do the replacements. What if the project restarts again, restarts and restarts? So I will recopy this again to here to simulate the restart. Now, this is first it take the place, and let's do the project that it restarts in the same way. Okay, now 1, 2, 4. Okay. And I'll take this. Okay. Now we equalized. Yes, they are equal in years. So one project restarted 4 times, the other project restarted 3 times. Okay, this is 3 times. This is 4 times. Our investment cost is 100. So the project G is lasting 4 years. Okay, 4 years cash flow. Okay, and 0 is the investment cost. Then we go again. We're considering the next restart. Let's say we are restarting again. This, we restarted 4 years, 1, 2, 3, 4. But we should consider the investment cost as well in the year before when it starts. So which is, we start at from the beginning, we started again at year 5, and we need to consider the investment cost in year 4. So which means that minus 100 plus 30. So this is restarting point. Minus 100 plus 30. Okay, we proceed. Then we restart it again. We restart it again. And our starting point with investment cost is 8 here. Minus 100 plus 30. So our restarting points, okay? Now let's go with investment project, which is 3 years. Every 3 years it will restart. So it's finished here and it restarts again here. So our investment cost will go in with the year 3. So this is the equal sign minus 100 plus 40. So we add it here again, 40, and we restart again here. We make our restart point. Let me just recalculate 1. Yeah, okay. Then here we start, then we make 40, 100 minus plus 40. And I'll put as a restart point. And then I restart again here. And my restarting point is here. Investment cost. Minus 100 plus 40. So the logic in here, guys, for you not to be lost, if you once selected investment cash flow 40, it will be continued, it will be repeating like sequentially, okay? Same here. So selected 30, actually all of them are 30. Okay, but if I want to just compare something here, look, you started at 90, that means next investment cost will be 90 as well. So this is kind of logic to follow so that you are not lost while calculating. Now we can calculate the NPV. NPV, we put the rate, 5%, and we take into consideration all the cash flows. Let me close the bracket, plus investment cost. Oops, it gave me percentages. Okay. Now, NPV for second one. $90. So this is my NPV. So now you can easily select which, but let me compare the NPV for this. To compare it. Oops, what's up? Rate plus investment cost. Cash $sign. Okay. This is NPV for before making the least common calculation. Great. Now, before making the least common multiple approach, before applying this multiple lives approach, then what you will do, you will just say, I will select this, but it wouldn't be a rational decision. It cannot be this. It cannot be like you cannot make such decision based on this because of the useful life. The useful life are not the same because whatever the projected cash flow you put here after the, let's say in the project H is 3 years, but in here is 4 years, and there is no guarantee that you will be able to get something. What if there is a crisis to take the place? So it's logical to compare in terms of the number of the year, there should be same. That will make a wise decision in terms of investing or not investing. So when we do it, we use the multiple. Now, we can select the project, which is the project H is having higher NPV. If you like repeat the same project with the same number of the years. So this you repeat 4 times, this one you repeat 3 times, but in total it will be 12 years, but with the same investment cost. So yes, you will say, I will repeat 4 times and that will give me really 19 million. So it would give me 4 million more. Let me save it. Okay, do you have any questions? Okay. Let me just compare the answers because I have not tried this one, but I'm correct in calculation. Yeah, it's good. 1594, 19, yes, it's correct. Okay, this was using the LCM method, but let's see, let's use the equivalent annual annuity method. So you can use the financial calculator to do it, and we can use the Excel, but I'm gonna apply the Excel. If you have a financial calculator, you can apply the financial calculator, you're welcome. I already said before that I uploaded the guideline for using the financial calculator. You can use that one guideline, or there's many lectures are available in the YouTube, you can find it out. But if you still have some issues regarding the financial calculator, we can arrange the meeting, separate meeting, and I can help you with the financial calculator as well. But I really prefer to use the Excel. Now,
What's the method called that we just used?
sorry,
How is this method called? Just how is it not called?
this method is called least common multiple lives. Okay, least common, LCM.
Okay,
Just called LCM, least multiple, least common multiple. Shortly, it's called like LCM. Let's use the payment. Now, same thing. We have a present value, which is 6.38 number. Like in here, we're trying to compute, if you remember from the finance course, from the previous classes that you took in the previous semesters, how to calculate the annuity payment. So we are in here trying to calculate how much annuity payment it would give you with this certain. So it gives you the present value. And in the first project, it gives you the project, let's say this is project, let me see, which project is this? G and H. This is project G. This is project H. So we will see which to choose, which project to choose, okay? According to LCM, we choose project H, yes? But let's see what we'll choose according to annuity. Annuity payment. Now, present value, it's NPV. NPV is NPV. Make it like this. N is representing the number of periods, years, okay. I is the interest or required rate of return. Interest rate. So they're both saying 5%. Now we need to calculate the annuity payment. That's it. How we do it? It's very easy. You just type PMT, open the bracket. So select the rate, select the number of periods, select the present value. And for you to get just positive number, put the negative sign here because it's always calculates as a negative number, but it's a matter of calculation here. Okay, we're just putting 180. So annuity payment will be 180. For during the 4 years, you will receive 180, 180. And let's apply the same thing here. So the rate is 5. Number of years is 3. And this is what we got it. So according to the annuity, we choose project H as well. Guys, give me just 1 minute. I'm coming. So, so according to annuity, we select project H as well. So our decision is to select H. Do you have any question how to calculate annuity?
is it normal that that the PMT give a negative result?
Yeah, it's a normal thing. If you calculate, like if you calculate just present value and itself, let's say the present, they all give you the negative now. It's normal thing. Like that's why you put the positive number. Okay, it's just mathematical issue.
Okay, thank you.
Professor, can
Yes, please.
two methods show different answers?
No, honestly speaking, I have not tried it, but logically it should not show you. Why? Because we are calculating basically the cash flows. Because in H, we have less years and it has a opportunity to repeat more than project G. That means that you will have more cash flows. That will bring you more net present value. And of course, that will bring you more annuity. So The question you asked, I have not tried it. I have not even thought about it, but logically it should not have, because mathematically it brings you more cash flows. That means that it will bring you more annuity payment every year. That means that you're trying to equate the cash flow that you receive. For example, cash flow we receive every year is different. And what if we receive in annual terms? Let's equate all the cash flow, make it in annual payments. How much we're going to receive equally. So more replacement it will have, the more annuity it will be actually. So logically, it shouldn't be.
Okay, thank you.
Which method is better? If we do not consider the amount of work needed.
They're measuring both. I mean, they both are okay. I mean, they're both used to come up with a decision, because these guys are considering time value, and this is considering time value as well.
Professor, could you please repeat the logic of this method?
In here, we're trying to see how you will receive the annually in equal payments, in annual equal payments, okay? Your present value is this much, and what if how much will be you will be receive, how much you have to receive every year so that your present value is equal to this one. So how much you should be receiving, okay?
Yeah, thank you.
So logically, if you're receiving every year this much, that means if you increase the number of the years, and here make it 12 and 12. Let's see what's going to happen. Okay, make the 12 years in here and 12 years in here. You see, it gives you even, because the present value is smaller here. Yeah, it's not logical to do this. No, it's not. No, it's my logic is not correct in here. That means I cannot make it equation. So in here we're considering just 4 years and 3 years. So for coming to the question, what we tried in here, coming to the question, which one is better to use? I would recommend you to use as a last resort decision this one, because in here we equate the number of the years and we're repeating the project itself. But this one, still it gives you some correct decision, but multiple leaves approach is like LCM is better, we can say, if you compare to this, in terms of the number of the years, in terms of the repetition. But guys, one thing that you should consider, that these things are like annuity, and this what we are trying to do is just a simple, I mean, the interest rate is not changing, the interest rate is fixed. But in real life, in the real market, the interest rate changes, and it gives you the different picture when the interest rate changes. And NPV is calculated in a bit different way with a different interest rate. But for simplicity, we're assuming it's fixed. So when the interest rate will change, and that will make the things really different, the NPV will be looking in a different way as well. So for you to know how to calculate the annuity is the most easiest part to calculate, but this will take time to do it, and to come up with a certain decision to accept or to reject. So you accept the annuity with a higher annuity here, and you accept with the 4 times. So most of the time they should give you the same answer, but your last decision should be based on LCM. Let me save it.
Professor, speaking about the changing interest rates.
Yeah.
So when interest rates change in the future, we just can predict it, right?
Yes.
I mean,
yeah, we're kind of predicting, like we're predicting the interest. You know, there's a formulation like Fisher effect and so on, like that are used to predict the interest rate.
and I assume that then we take the average of these interest rates and
No, not the
Okay.
average. So for every year, When we finish this all chapter, okay, just for you to have some idea about how it is used with a different interest rate, I'll give you one example. But when I finish everything, when this all chapter is finished, so at least you could have idea that, whoa, how it could work and how it could be if there are different interest rates are applied actually in different years.
Okay.
But you will not be responsible for that, for this different, just for your own information. If you will need to study more, I can share the information with you more. I have lectures related to different interest rate. So it's a capital budgeting still, but with a different, which is more close to the realistic example, to the real life. Okay, let's move it further. So decision making under the capital rationing. So when there's a capital rationing, the company may not be able to invest in all profitable projects. That means that you have budget constraint. Even you are given all projects are profitable, you are not able to select all of them because you are not having that much capacity to go for all of the projects if those projects are profitable. So the key decision making under the capital rationing is to select the project that maximize the total net present value. So here what you should keep in mind, I will select the highest NPV. Okay, if there are 3 projects you need to select, you will select 3 with the highest NPV as a summation, as a cumulative. So the example is given here. There are 5 projects with the initial investment cost, as you can see, and $20, $30, $40, $15, as you can see, respectively. The NPV, the PI are given as well, and IRR is given as well. So here's the question: which project should be selected if the capital budget is $100, $200, and $300? So tell me, if it's $100, which project would you select? I mean,
The first project.
Yeah, project 1 would be selected. Okay, let me just make it. So project 1 will select if it's 100. Okay, if 200, which project would you select if it's 200?
1.
Still first one.
Why? Why not 5?
Because NPV is greater.
Very good. So we select still 1 project. Great. If you have a $300,
2.
1.
2.
Higher. 2.
think carefully, please. Our investment criteria is, our approach is to get highest NPV. You can combine even 2 projects.
So 1 and 5.
1 and 5, perfect. 1 and 5. So we select 1 and 5 because in summation, 15 and 20 and 15, you're gonna have 35. But if you select only project 2, it will give you NPV of 30. So which one you prefer? Which gives you by 5 million more or less? Of course, more. So what if you have $400?
1 and 2.
1 and 2.
1 and 2, perfect. What if you have $500?
1 and
Probably 1 and 3. 1 and 3.
1 and 3.
1 and 3, because it gives you the highest, $20, $40. Yes? Okay. This is you selected by NPV, okay, by highest NPV. The same thing you could select according to PI. So in here, the profitability index, it plays a very significant role in determining which project to choose according to PI. So you will select with the highest PI. The higher the PI, the better is the project. So let's go with the first decision to clarify your selection. You said that if it's 100, you will select project 1, yes? It gives you highest NPV. Or it's just because of the budget constraint, actually. you select this one. And it gives you the highest PI, you can see it. If you select 1. If it's $200, if it's
Still
200,
1.
still 1. If it's $300,
1 and 5 again.
1 and 5. Why? You can select by according to PI, you can select these two, yes? Or this and this. But why you cannot select it?
Because we don't have enough money to select both 1 and 2.
Very good. So you will go, so on one side you have a budget constraint, on the other side you have PI to select. So if it was not, if you didn't have any budget constraint, then you would go for 120. If you said you're gonna select the 3 projects, you're gonna select the with the highest PI as well. So in total NP with the highest NPV. So if you have $500, which would you select? Look, we said if we had $500, we would select 1 and 3. 1. We select 1 and 3. Yes?
All 1 and 2. They're both the same, but we will still have $100 left over.
No. We shouldn't have anything left, any money. We should use all of the money. Why we cannot make the money to be left unused? The reason is that is the time value, because the money, if it's like in the bank account and it doesn't earn anything to you, then it's meaningless to keep this money because it loses its value. So if we have $500, we should use all of it with the highest NPV. So 1 and 5, or so 1 and 3, it gives you 60 million of dollars. But let's see how the PI clarifies it. We could select this one, but we cannot, yes, because the PI is lower in here. So PI says select this 120 and 110. There was a question. Okay, Bekjan, take your time. We're actually done already. So we say that we select according to our rationality, we select with the total higher NPV, and that gives you more NPV in total. And we clarify our selection with profitability index as well. So once we select 1 and 3, as you can see that PI is the highest at this NPVs. And it is always the case, okay? So you can use as a total summation PI, the NPVs, or you can just use as an additional clarification. So PI as a, but what about IRR? Look at the IRR. IRR is not really reliable investment criteria, we said before, because there's a multiple IRR issues. If there is like negative cash flows that happen twice in a year, so in a project, you may have more than one IRR in one same project. And so you will be kind of in a different position, which IRR to choose. So this is the decision actually. So let me stop here. And this is what we have decided. This is what we have making the choices, like optimal choices that maximize the total net present value for any given budget. So if you don't have any question, thank you so much for your attention. See you tomorrow.
Goodbye.
Yeah.
Thank you, Professor.
Bye.